for having me. I know it's been a long time coming, so. So we're about to get right into it really quick. All right, so I'm gonna use the dollar as an example, all right? So let me get this thing going. Let me pull up my chart and then we'll get right to it. All right, 55%, so I'm good. So launch. So I think the dollar, US dollar pairs, okay. All right. All right. Okay. Let me Forex Factory really quick. September. All right. Okay, good. I have what I need. All right. So I'm about to share my screen. Can you see my screen, guys? Can you see my screen? You should be able to see my screen. Can you see my screen?
Yes, we can.
Okay, all right, cool. All right.
Yeah.
All right, so you know, Mr. Vine has asked me to drop a little something with you guys. So basically, as I just mentioned to her, I said sentiment is important, all right? So what does sentiment mean? It's basically the mood of the market. It's the tone. That's really what you trade on a daily basis. You're trading the tone of the market. You're trading the mood. Remember, the market is like a person. It has mixed feelings. When the market is happy, the market is bullish. Obviously, prices rally. When the market is sad, when the market is scared, frightened, then you see prices fall, okay, respectively. All right, so understand that sentiment and daily sentiment based off political events or certain things that may occur across the globe will have an impact on the market, because the market is a visual representation of actually what's going on. If you didn't know, obviously the candlesticks are the best version of that now. Okay, so anyway, let's look at the US dollar. All right, so the US dollar, the DXY, as you all already know, if you don't know, is basically a basket of nations that are pegged against the US dollar. Why? Because the US dollar is the world's most liquid currency. Second most liquid currency is the euro USD. So that's why that pair is traded so much, because it's the world's largest economies. All right. So that's why it creates a lot of volatility and a lot of volume. All right. So that's just the basics. Understand. So this past week we had the FOMC rate statement. Now they did increase the rate from about 2 megabytes to 2.5 megabytes. Obviously, that's a quarter raise. All right. And if you do tune in to me in the morning at 8 a.m., I virtually touched a lot of base, a lot of times on that. And I said, excuse me, I'm outside. So I did mention that I don't really care too much for the number. I don't care too much for this number. All right, because it's already priced in. When I say priced in, the market already had that expectation 100% follow through. All right, 100% follow through. So it's already baked in. What I cared about was the economic projections. All right, so whenever you see like certain red folders, you may definitely want to look at them. All right, especially if they're involving the US dollar. Why? Because the US dollar basically accounts for over 60% of Forex transactions, period. All transactions in the world revolves around the US dollar. Make sure you understand that. That's why it's so important. It's the world's reserve currency. All right? Understand. Let me repeat that again. It's the world's reserve currency. That means each respective nations, you guys may already know this, has a certain amount of US dollar in reserves. All right? Very important you understand that. Anyway, so when I say obviously hawking obviously to 2019, basically growth covering over the next 2 years. That's what I cared about. That's what was important to me during that news release. All right, that was very, very important. I'm going to show you a very good example of how that merges with technical analysis. All right, so as I expected, they were going to maintain their hawkish tone. They'll continue to hike rates throughout 2019, and there is another rate hike coming. So I expect those prices to be well supported. The U.S. dollar be well supported by that. Economic data is good, and so forth. Unemployment's been the lowest as it's been in a very long time. GDP numbers, even though we slipped that a bit small, but the overall tone, just because there have been so many longs in the U.S. dollar, it's the bullish presence is still very much there. So overall economical improvement, and obviously they're still going through a very strong tightening cycle. All right, tightening cycle. What does that mean? That means basically you're tapering off your balance sheet. All right, you're leading towards an aggressiveness towards rate hikes, which means tightening. You're tightening up the budget. All right, you're clearing debt. You're tightening up the budget. All right, so rates. That's a tightened cycle. Anyway, so as I said, they did maintain their hawkish tone. So obviously that's good, definitely for the U.S. dollar. Then the press conference. So this is a chance where they get to analysts and news reporters and so forth. They get to speak directly to the Fed chair because remember, the market does not like shock. Okay, it does not like shock. What is shock? Brexit. That's one example. The Swiss franc, 2015, I believe, or 14, when the Swiss franc basically fell out the trading floor, and that was pegged to the euro for a very, very long time. It's still pegged to the euro and so forth, but the trading floor fell out under the floor, and then that's why you saw a huge, just crazy decline in the euro Swiss franc. Go back maybe 1 or 2 years, and you see what I'm talking about. All right. So anyway, so it's their job to communicate with the press, communicate with the world to let us know what their intentions are, what their next move is. That's how you begin to learn to read sentiment. All right, you listen to these political speakers and listen in what they have to say. Are they worried about something? Whether it may be tier 1 data, which is inflation. All right, that's a leading indicator towards gross domestic production, which is an overall economic state of health for the currency. All right, so GDP, CPI, housing, retail sales, all of these key data points make up that GDP. All right, so when you see certain things on the calendar as a daily or morning routine, you definitely want to make sure that you understand that something major may be coming out, and you want to cover your positions so that you don't speaker. Prime Minister May spoke that morning and turned the pound to shit, all right? Because there's some political turmoil going on over there. All right, so anyway, so now that you have a general understanding of how to really flow through this calendar, all right, become aligned with it, see what's the next major news event, document these things so that you have, your overall bias. All right, what kind of directional bias? All right, we're having. So, and as you can see, final GDP came in on Thursday, 4.2. That's the highest it's ever been, ever in history for the U.S. dollar. That is a powerful thing. Then Fed chair Powell came back out and reassured that reassured that stance. So let's jump on over into a chart now. So you all know that obviously I use these technical tools now, moving averages and so forth. That's really just really what I really use. I just recently started incorporating this, again, just to accommodate some of my technical traders on our side. But anyway, so obviously this is a 50-day moving average, exponential. Then you have the 7 and 17. So anyway, obviously when price is under the moving averages, then that means there's a sell-off in price, or you can expect low prices, especially on a higher time frame. All right. And then obviously when it's under the 50-day moving average, Some people use different averages. Pick one to your liking. I just use that more. The 50 is more of a directional bias. These are more intradays, especially when you see price action bounce. They typically bounce off of them, so they'll act as the 17 and 7 will act as dynamic support or dynamic. All right, that's very important. So understand that. I don't know. Somebody's mic there. Somebody's mic. All right, thanks. So anyway, as you can see, so please mute the mic. Please mute the mic. Anyways, so obviously when price is above the moving averages, you'll see that it'll tend to support it, okay? And then obviously when we get a break back below, especially on the weekly, obviously the moving averages on a shorter time frame may have already crossed. All right, so that's just basically what they are. They're just used for directional bias, all right, to help you assist to where most likely the trend is going. And as you can see from when the US dollar snapped back, this is a DXY, back above the moving average on this weekly time frame, then obviously it's being supported by it now, as you can see. So let's say if you didn't know anything about politics or sentiment or anything like that, you will just know that we're approaching the 50-day moving average, and most likely there'll be a rebound from here. All right. So now that price is above this, it's obviously being supported by it now. Okay. Very good. So make sure you understand that. You had a question. Remember, guys, I'm not gonna be here too long. So, okay. All right. Beautiful. So understand that's how the moving averages work. So especially when there is a cross between, let's say, the 17 and the 50, then you know that a potential strong trend may be in play. All right. So, okay. I'm going to move over to the Euro USD, which is a negative correlation to the DXY. And when I say negative, it's basically the DXY turned upside down. So as you already know, once again, what did I say? It's the same thing. You can see now that we've basically closed back under it. And what we did, we came back and retested it. All right. And obviously there's some strong intraday resistance levels right here. So ever since that level was created back in June during the summer, we retested, remember this is a weekly. We retested it and we rejected it. But one could just say, hey, I've rejected the 50 moving average. Right? Yes, just when you think they're about to cross, not yet. All right, so that resistance level comes in at about like 17,560 or 17,550. So anyway, that's a weekly chart. So when I come down to the daily chart, what happens is obviously what you want is for the weekly and the daily usually to be in rhythm. And then obviously an execution time frame like the 4 hours. So if you have the 4 hour, the daily, and the weekly MAs all are moving within the same direction, that means that that's a strong trend. It's a strong trend, but at the same time, that strong trend may be coming to a correction. All right? Did that make sense? Do you understand where I'm going? Is you want to make sure that the smaller time frame moving averages are in alignment with the higher time frame moving averages. All right? So that's just basically how you would use the moving average as the guidance. So anyway, you can see that there was political tension that came in. So what I mean by political tension is the European accounts right here. The CPI, this is what I was looking for. I was looking for something for the euro. Was it here? Euro, this past week, something negative came out. There we go. Core CPI came out negative. So it failed to meet and or beat expectation. It came out lower. Like I said, consumer price indexes is a leading indicator. It's inflation towards GDP. So this number didn't come out too well. So obviously that was, you saw a reaction with that. But more notably, what's going on with Italy and their rate budget has increased. All right. Their rate deficit has increased, and that expresses the concern. So immediately the market took a reaction to that. All right. So a market's just not going to move on its own. There has to be some sort of motive in order for it to move. Okay. besides it just hitting a technical level. So there were concerns, obviously, with the Italian budget rate being so high, and this is now being reflected in the market. Just seeing potentially as a correction in this downtrend. Now, mind you, this doesn't mean that this, let's say, this inverse head and shoulders pattern that you're looking is over. This really needs to break this level in order to confirm that this downtrend is well back intact. But the point is that you have an overall directional bias of where price could be leading to next because of those fundamental driving themes. All right, we missed some inflation figures, but most notably the deficit of the Italian government, and then you have the central bank divergence, which is my favorite. You have if I just come to the DXY, naturally when a dollar is strong, the anti-dollar crosses are just going to be weak. That's just what it is. Because remember what I said earlier, they're negatively pegged against the US dollar. Okay, so one could still say this is still the left, the right, left head and possibly right. But until we see a real key technical break back above some certain levels, then I'm more in favor of a dollar long, a strong dollar. So we can look to continue to buy certain dollar crosses. All right. So as you can see, there's multiple confluences adding together as far as sentiment. There's one, I keep referring to them. They missed some crucial CPI numbers. 2, the Italian budget. 3, the central bank divergence on a stronger greenback. Okay. So we can potentially look to keep selling. All right. Then what is the visual representation of this? Well, you should all probably know this by now. All right. What confirms this resistance? Number 1, you have obviously a disc. You can consider this an inside bar. Number 2, shooting star doji. All right. Shooting star doji. Huge wick rejection. All right. Confirming this resistance. We may try once, 2, 3 times. Obviously, you can look at these as stop hunts. Some people call them. All right. Because there's a lot of liquidation up there. So there's a lot of people who may have saw this, gone short here, and the stop loss is right there. Stop hunt, stop hunt. And then obviously you see price keeps rejecting a zone. And if it keeps rejection and this cannot break, then obviously evidently what happens, price has no choice but to head in the other direction. No choice at all. All right? There's nothing you can do. That price is going to drop. And then obviously what do you see coming in? You see divergence, all right? Or just take a look. You see one rally cycle, pullback, another rally cycle. Well, this pullback, this has already broken a significant trend line. 1 touch, 2 touch. Obviously, usually on the 3rd touch, you may get a high. But if we break, obviously, I expect price to make it back down to the previous area of support. But there was divergence coming in once again. Oscillator coming down, prices going up. That's divergence from a technical standpoint of view. All right, so there's divergence coming in. I know what's happened with political tensions overall. So why? And then obviously a stronger dollar. I'm not saying you have to gather all those reasons, but why not? If I have it from a technical standpoint of view, it's starting to make sense. A triple top, 1, 2, 3. 4 attempts, 1, 2, 3, 4, and then the oscillators coming, making lower highs on the oscillator. That's divergence, and I know what's going on politically. So then why not? And if you just want to be a little more technical, if you want to be as technical as you can, there's obviously a harmonic pattern sitting right in front of your face as well. Known as a Gartley, maybe a sharp, whatever they call these things. All right? Or sitting basically right in your face. All right? So, like I said, guys, in all honesty, that's just really how you do things from, a technical standpoint of view, a fundamental standpoint of view, and then when it makes sense, the both of them, you can merge and marry them. Some people, don't really pay attention to fundamentals, and that's okay. That's fine. If you want to be a purely technical driven trader, you can do that, but just understand if you want a better gauge of sentiment, then you have to understand what's happening. And I'll just, throw in a little extra treat. Risk trends are very important. These are obviously the S&P, which is coming to, I don't think this can really keep up. The sentiment could keep up. They're starting to have divergence coming in here on a smaller time frame. See, the oscillator just starts making lower highs, price is still peaking. So that's telling me right, when the market's getting scared that safe haven currencies are going to, there's going to be some strength in some safe haven currencies. So I may look for opportunity, obviously, within the pound yen, euro yen. We did have a rejection over there, but the next one, as I just mentioned on my live, is here because we're heading into a very strong area of resistance. 1, 2, 3. Last time we've been up here was last year. I find it ironic right around this time this year is when we'll most likely come back up here and fail again. All right? And so forth. So this is going to be a very crucial point that we're watching. We're most likely going to be definitely looking for some shorting opportunities, taking something off this A, B, C, fib retracement pullback 127. But this is in a rally cycle on a daily higher high, higher low, higher high, higher low. The market is probably pricing a higher high now at this 127. So I expect prices to get up to here by the end of, I'll say maybe most likely by like Tuesday, Wednesday, and then we'll see what happens right here. All right, guys. So that's, basically it. I'm about to run up out of here now. Go attend back to some family business. But what the key points is what we covered today was obviously that sentiment, as you can see, how to interpret that data, how to use that Forex factory to your advantage, knowing where you are in the market at all times, and just basically interpreting that data and then, merging it with your technical analysis to get overall bias. All right? Okay. All right, so that's basically it. So hopefully that made sense to you. All right? I'll catch you guys later. Have a good one.
Thank you.
No problem. All right.
Thanks a lot.
No problem. All right.
Thank you.
Welcome.
Thank you. Thank you.